Hey, happy Tuesday to you all out there. Glad you're joining me today for long options. And today I want to talk about the Sizzle Index and using that to help us find potential long option trades. We'll get to that in a minute. But before we get there, let me just mention I'm joined alongside Connie Hill, who's helping me on the chat. Appreciate Connie. She is a fellow instructor here. And if you haven't checked out her short Verticals webcast on Thursdays, which occur on Thursdays, 2 o'clock Eastern Time. Make sure you check that out. You can also follow us on X at Brent Moore CS, at Connie Hill CS for additional content. We'll get to the long options here in just a second. Let me go through a few important disclosures. Options do carry a high level of risk and are not suitable for all investors. And the information today is for general informational purposes only. It's not an individual recommendation or endorsement of any particular security, chart, pattern, or investment strategy. Schwab does not recommend technical analysis as the sole means of investment research. All investing involves risk, including risk of principal. And past performance of any security or strategy does not guarantee future results or success. I'm not going to factor in commissions in these trades when we look at sample trades here, but just realize they are something you should pay attention to. So let me just hit a question right out of the chat. How long is considered long? When we say long, we're not referring to the duration of the option. We're talking about the posture, whether you're buying the option or selling the option. When you buy an option to start out a trade, it is considered long. So if we're going to buy a call, it's a long call. If we're going to buy a put, it's a long put. Whether we hold that for 5 minutes or five days or 5 months, it's long in that case there. So there we go. So this is what we do in this class each time. We talk about long options. There's some, we're in some ways we're limited in the scope of what we talk about here, but in some ways there's a broad variety of things that you can look at. In fact, if you look back at the past playlist on this class, on this webcast, you'll see a lot of different topics. Last week, we really did do long options in the sense that we did leaps. Maybe that was a couple weeks ago, actually, in there. But just realize there's a whole library back there that you can check out here. Let's go. And I mentioned the Sizzle Index. Well, what I'm going to do today. Today, I want to talk to you about what the Sizzle Index is. What are the basics of the Sizzle Index? The best way or potential ways to view it. Maybe there's no best way to view that Sizzle Index. And I want to go through some long call and long put examples to show you how it works, well, how you may consider potential opportunities there with that. Of course, none of the trades that I go through today, and we'll go through some example trades, none of them are recommendations there. So what's the Sizzle Index? The Sizzle Index simply just compares the options from today, the volume of options for today versus the average volume we've seen over the last 5 days. So there's different ways to see that, but you can think about why that may be impactful, why that matters. If more people are trading options right now on a security right now, then what does that tell you about it? It tells you that there's more interest in it. It doesn't tell me whether the stock is going to go way up or the option is going to do really great or not, but it can be an indication that there's a lot of interest in that. There's other people looking at that. Now, the other people may be dead wrong in their assessment of what the option is going to do or what the underlying stock is going to do. But it does show you where people are looking for trades. And by extension, it may give you an indication of some potential fishing grounds, so to speak, for your potential trades there. Okay? So I'm hoping that makes sense. And the Sizzle Index can tell you that for options in general, or we can break it down to call Sizzle Index, where we're just looking at calls, or put Sizzle Index, where we're just looking at puts to try and find what is of most interest to people there. So, so practically, more people are trading the option if the Sizzle Index is high. Fewer people are trading the option as compared to the average over the last 5 days if the sizzle index is low. And because we don't know, what the stock is going to do, a lot of times we'll use other things like technical analysis to try and help us out on this. Now, I have the SPX up here right now, and you may say, well, the SPX is trending up. We're above that 20-day moving average. We kind of bounced down off that moving average. We bounced off again off that moving average. The general trend has been up, therefore more bullish on it. Well, that's fine. But what's the sizzle index going to tell us? Well, one place you can do on any stock that has options, you can go down below where that option chain is. I'm on the trade tab, by the way, right there. Go down below that option chain, and we got a long option chain on the SPX because it's an index option there. And you can go to today's option statistics, and you can see the sizzle index right down there. Now, that is kind of, this probably isn't the best example because it's an index option where there's we had options expiration and whatnot. But let's just pull up Microsoft as an example. Same thing, trade tab. I'm going to go to all products. I'm going to scroll down below it, and I'm going to look at that sizzle index. So how are we to interpret this? A sizzle index of 1 would mean today's options volumes are equal to what the average volume has been over the last 5 days. So that's our benchmark, sizzle index of 1. What can we see here on this sizzle index? Well, the sizzle index is about 19 or 20% higher than what it's been average. For Microsoft, for this particular stock there, it's a little bit higher than what it is. Not, ridiculously high or anything like that, but it is a little bit higher. Now, specifically in terms of the calls, it's a little more interest in the calls than the puts, but all in all, call activity and put activity has gone up in this stock, and I wouldn't consider that to be a meaningful difference between the two. I would not consider that to be a meaningful difference between the two. There. Now, sometimes we'll get the question regarding, and it's not really the topic I'm talking about today, but it's so close and it's something you're probably going to have a question on, is this put-call ratio. What is the put-call ratio? So let's talk about that because I think it's a related topic. And the put-call ratio basically just tells you the number of puts that are being traded versus the number of call contracts that are being traded, okay? And so if it's 1, that would mean there's an equal number of puts versus calls. If it's less than 1, that means there's fewer puts than calls. So they're pretty similar, but they're not exactly the same. The sizzle index is comparing these to their last 5-day average. The put-call ratio is just looking at today, looking at the number of puts and number of calls. So when you interpret that put-call ratio, a number of less than 1 means there's fewer puts, and some traders interpret that to be more bullish. If you have a lower put-to-call ratio, in other words, less than 1, then it would be often deemed to be more bullish. And if the put-call ratio is above 1, then it would generally deemed to be more bearish on that. But you never know. You could have a high put-call ratio, and the stock could still go up. Anywho, that's your call sizzle index, your overall sizzle index, your call sizzle index, and then your put-call ratio. And if you have any questions on those, feel free to type those in the chat, okay? Between Connie and myself, we'll do our best to help you out on that. So this is one place to find these. Now, there's some limitations of this. This is great if you want to look at a particular stock. I'm looking at Microsoft, and you want to see what those stats are. But if you want to find stocks with unusually high sizzle indexes, for example, then this is probably not the most efficient way to do it. Instead, what you may choose to do is you may choose to go, well, there's different ways we can do it. One way is to do a scan for it. We covered scans in this class I think it was it last week or the week before? I'm confusing the LEAP session and the scans, the flag scan session that I think maybe we did last week, but you can go back and review that session if you like on creating a scan. If you've never used this stock hacker before, it can be a powerful tool. And so, so there we go. Let's go and let's talk about how you would do this. Let's say you're doing a scan. Now you could do a bullish scan. I'm going to do a bullish scan here, which is one that I've saved in the past. In fact, one that we went through in this class in the past. I'm going to load that scan query, and I'm going to go and just do a bull flag scan. Okay, here's my bull flag scan, and I could just scan for this and pull that up if I want to, and fair enough, that's what we want to see. Now, you can create a bullish scan there if you want. Now, you can also add in columns down here, or you could add in the sizzle index as a parameter, okay? So now, question in the chat, does this consider only long calls and long puts, not short calls and short puts? This considers, the sizzle index considers volume, option volume. So when there is a trade, there is a buyer of a call and a seller for the call, okay? That is an open contract. Now that seller of the call that is bought may be a market maker, but there is a seller of that call, and vice versa, there's the buyer. So a long call and a long put, a long call and a short call together would equal one contract in the options volume there. Okay? Hoping that answers your question there, Debbie. Good question, though. Very good question. So, so therefore, if it were just long, let's say long calls, it would probably be easy to say, oh, that is a very, very bullish sign if we have a high call sizzle index. But the reality is, for every buyer, there's a seller. And so, yeah, the price is adjusting and it muddies the waters a little bit. I'll be the first to admit that to you. It muddies those waters in terms of just saying definitively, this is very bullish or this is very bearish. Okay, so I'm going to do here. Now you can create your bull scan here or create any scan that you want. In this case, I have a bull flag scan. And I can, if I wanted to add the sizzle index, let me just get rid of this left-hand column here. If I wanted to add that, I could just click on Add Filter and a Stock Filter. And I go up here to where it says Last. And there's Put Sizzle Index. There's one for Call Sizzle Index you can do. And you can put in your minimum parameters on those. However, I don't think that's necessary because let me get rid of this. And let me just run this here, okay? So I have some stocks listed and I have a column for a call sizzle index and I have a column for a put sizzle index. In this case, here's my call sizzle index column. Here's my put sizzle index column. It doesn't matter what scan I run up here. I can view those. Now, very often, what we have is we do, you'll see them both high. Let me just see if I can find an example. This is not a perfect example. If we look at Alphabet, Google here, the call sizzle index shows higher than average call activity. The put sizzle index has a higher than average, and therefore they're both actually high. So there is a disparity between the two. The put sizzle index is higher. The call sizzle index is lower than the put sizzle index is high. So maybe you'd consider that to be a little bit more on the bearish end of things. But sometimes you get a pretty big disparity, such as, say, Abbott Labs. So if we look at Abbott here, there's my call sizzle index. It's kind of bullish. My put sizzle index, kind of bearish. Let's take a look at the stock here. Okay, so let's go and let me click on here. Here's Abbott. And here's what I'm going to say. I'm going to say, does my technical analysis support my call sizzle index bullish posture? And I'd say for the most part it does. It's, I'm sure you can probably find more bullish looking stocks out there in terms of technical analysis, but we have had a series of higher highs there along this. We've had a nice little trend up. We're just a little bit above that 20-day moving average, and we've been remaining above that. So from that standpoint, I'm going to call this a bullish possibility there on that. Okay, hoping that makes sense. Let's go. Let's go forward on this here. Okay, so I'm going to call this bullish. That is one way to do it, is you can do it on the Stock Hacker. And I want to do a sample trade on this in just a sec. But let me mention this before I lose my train of thought here. If I then go ahead, if I have my scan, if you save a scan, you can always, if you create a scan, you can always then save that scan query. And then what you can do is when you go over to you can pull up a chart, you can pull up a watch list over here. And if you save that scan query, you can go over here and you can pull up I don't know if this is the exact same scan I had before, but you can pull it up over here and you can add your columns over here. We'll get to that in just a minute. But right now, let's look at Abbott Labs and we're going to decide what kind of trade would we be looking for? Well, we're looking for a long call here. What's my time frame? That's always the questions with long calls or long puts. What's my time frame? If I'm planning on holding this a long time, I'm going to look for a longer term dated expiration. If I'm looking to hold this shorter term, maybe this is just a swing trade, or maybe I just say, look, here's kind of where we peaked out not long ago, up at the 136 or so range, not too far. That's going to be my target. It's probably not going to take that long to get there. Maybe I'll just buy for 3 weeks or so, 3-4 weeks. And so you can do that. I'm going to go to trade. I'm on Abbott. I'm going to go to that shorter term trade. Let's go look at Abbott. I'm going to go out 24 days, and I'm just going to kind of double check my bid-ask spread on these. Okay? I'm going to double check my bid-ask spread, about 15 cents here. Now that may change as we talk a little bit, but that seems reasonable. That's about 5% difference between the bid price and the ask price. And I'm going to look to buy this trade, buy a long call here. So I'm going to right click on it. I'm going to buy custom with the stop. And I could put this in right here. And I can say, well, I'm buying the call. I can put in a stop loss on this. Let me get rid of this left-hand column. And my stop, I'm just going to put in at half the price we enter at. Well, half of 320, I'm going to say is about 160. I'll round up. We're at 325. I'm going to say 170 here. Okay. 170. There's my stop. Good till canceled. Easy enough. That is a long call trade if we wanted to enter that trade. Now, when we look at Abbott, we could say, well, I also want to get out. I want to set a target price. And I could set that target price if I want, not based on the option, but I could base it on the stock as well. If I wanted to trade an exit based on the option price, on the stock price, instead I would go to the gear, and I show this pretty much every week in here, so you can always look at past sessions, and maybe I'll do one later on this, and you can add it in right down here. You can add in where you put in that stop rule on there, but I'm not going to do that. What I'm going to do is this. I'm going to make this, instead of first triggers all, I'm going to make this a first triggers OCO. I'm going to add in a second exit order. Now, I actually didn't have to do it that way. I could also just right click on this in the first place and click on buy custom Instead of with stop, I could do with OCO bracket. Either way, works just fine. Buy custom with OCO bracket. That means I have a buy order on my long call, and I have two sell orders on that long call. One of those is going to be a stop. I'm going to leave that as stop. I'm going to make it good till cancel. And what did we say? We said the stop was going to be about 170. 1.70. But this second order right here, this is going to be my target price. And what I'm going to do is I'm going to say, look, if this option goes up to a certain price, I can get out of this. I'm going to say, if the option price doubles, I'm going to get out of this. So what if we get out, what if we make it 650? That's going to be doubling that option price. There's 650. And I'm going to make that good till cancel as well. And just so everybody is clear on this, this first order is an order to buy. This is an OCO order. What that means is, once this first order fills, these two sell orders become active. One, if we goes up and hits 650, the option that is. One, if it goes down and it hits 170. That's not the good scenario, but it's there to try and help protect us. It's not a guarantee to get us out at 170. Stops aren't guaranteed. But what this does is we now have two orders to sell. What if the stock jumps up and it sells this and then it drops? Would it sell again? No, because this is an OCO order. In other words, it's a one cancels the other order. Whichever one of these, order A or order B, fills first, the other one will cancel. Doesn't matter which one fills first. If B fills first, A will cancel. And that way we're not on the hook to sell more contracts than we've bought in the first place. Now, I wanted to give you an example based on the option price. We can look at an example as well based on these orders on the stock price as well, but this is on the option price. One thing with long options I would encourage you to consider, in fact, not just long options, other option trades or stock trades as well, is consider your reward to risk ratio. What's my reward on this? Assuming we got out at our limit price and assuming we got out at our stop price. Well, we're entering at 325. If indeed we were to sell at 650, that means we would gain 325 on this. If we were to get out, if the stock went down to 170, assuming we got at 325, that is a $1.60. Did I have to do that right? My math, I can do this. I can do this math, believe it or not, even though I'm taking out my calculator. 325 minus 1.70 is 155. That means I'm risking 155 on this. So my reward to risk ratio, if you want to express it this way, would be 325 to 155. Or of course, you could just say 325 divided by 155 gives me just a smidge over a 2-to-1 ratio. 2-to-1 ratio. Do you have to have a 2-to-1 ratio? No, you don't have to. A lot of traders will actually kind of target that 2-to-1 level on that, but you don't have to. But I would probably encourage most traders to consider something better, something higher than a 1-to-1 ratio. Now, when you have a ratio of 2-to-1, what that means is you can lose more than you win and still be okay. Because let's say you lost, let's say you lost 60% of the time, but you won 40% of the time. But when you won twice as much as when you lost. You would still have what we'd call a positive expectancy there. Positive expectancy there. So there we go. So Sia says, you want to get out of a loss of 52%. I don't want to get out at this. I hope it doesn't come to fruition. When we put in a stop loss, that is kind of what happens is you're accepting the loss. Now, why don't we make it, say, a $3 stop or a $2.50 stop or something like that? Well, you can, but options are very volatile. Okay, they're very volatile, and intraday moves can trigger out you very quickly. So if I did a 250 stop, just as throwing out a number out there as an example, it's very likely this stock would still be doing more or less what going generally in the right direction, but just kind of a blip down and stop us out. That's why when I did, this is an at the money option I went with about a 50% stop. Now, if I go in the money substantially, I may move that up to 60 or 70% stop. But that's the reason why I just did that trade. Okay. So there we go. That's the trade. And let me click on confirm and send. I'm going to throw this in my long options. There it is, long options. And this is just going to be what we'd call a kind of a swing trade. And I'm going to send this order. And we failed. Okay? So let's, now, if you have further questions, feel free to type those questions in, but we want to push forward on this, and I want to show you a little bit more about using that sizzle index. Now, I could just as easily, of course, do the same thing with the bear flag, do a pass scan. If you have a bearish scan that you want to do, and let me do bear flag scan. I'm going to scan that, and I'm going to look here, and I'm just going to sort this by my put sizzle index. Ideally, my put sizzle index would be high and my call sizzle index would be low. Well, in this case, like our first one, Comcast, call sizzle index will say that's about average. Put sizzle index is, I'd say, significantly above average. So maybe we'll look at Comcast here. But just to quickly glance down, Intel, the put sizzle index is low, a little bit lower than average. The call, so that's not looking real bearish. Even some of these, most of these right here on this have a kind of low across the board on these, but this is the one with the biggest disparity. And so let me get rid of that. I didn't want that. What I'm going to do is let's look at Comcast. Now, again, I want kind of a bearish type trade on this. In general, we've been trending down on this. Lately, maybe it's picked up a little bit more bullishness on there. Okay, that's kind of the trend we've been on. And if you want to wait, make it a contingent order of the stock going below a certain level. So for example, if I say I want to do a put option, but I only want to do that put option if we break below maybe a recent support level, maybe that's where I want to get in if the stock goes below 34.10. Just jot that down really quick. We can do that. Okay. So yeah, we'll see. Chris pointed out it's kind of a squeeze stock. It's been, in fact, if we were to do a Bollinger Band, I bet what we'd see is that Bollinger Band would be kind of squeezing together on that. I don't have that as a saved study. Let me just throw that on there just to kind of illustrate the point. Here's a Bollinger Band. I'm going to get rid of let me just get rid of, just to declutter, I'm going to get rid of those moving averages. And so with Bollinger Bands, and we've talked about this in other classes, sometimes they're wider, meaning more volatility, and then they kind of constrict. Okay, here we've constricted. And the theory is when they've constricted, they tend to then move one way or the other. Now, in this case, if we're doing a long put, we're hoping it moves down a lot. No guarantees on that. but they tend to move significantly one way or the other. And remember, with options, big movement is generally good. That's why even if you don't know the direction, if implied volatilities go up, that is, expected volatility of the options go up, or expected volatility of the underlying stock goes up, then options are going to be more expensive. And the reason for that, one reason for that, is that there's an asymmetry. There's a disparity between potential gains and potential losses on your option trades. Let me give you an example of that. When I go to my trade tab, and we're going to go at them, and I'll go out 24 days again here, okay? I'm going to go to the put side of things. I'm going to go stocks around 34 and a half. I'll go up to the 35. We'll go just a smidge in the money here on this. If I look at this option, this long put, what's the most I could lose on this? Okay. What's the most I could lose? Well, the most I could lose is the amount that I spend for it. In this case, it's $100, okay? $1 times our 100 multiplier. $100 is our max loss. What's the most I could make on this? Well, it's a $35 strike price if the stock went down to zero. Now, admittedly, it's highly, highly unlikely this stock is going to go down to zero, but just to illustrate the point. Basically, my max gain, so let me put ML for max loss, my max gain on this is about $3,500. Now, I'm not factoring in commissions on here. So when I say there's an asymmetry between these two, then that's what I mean by that. There's potentially a much larger max gain than max loss. That's true for long calls or long puts. Now, probability traders say it's a low ATR stock. It's a stock that isn't moving much. Absolutely. Are there pros to that? Yes. Are there cons to that? Yes. What's the pro to that? Stocks that don't move as much, particularly when measured by an implied volatility, that means they're going to be cheaper. It means we can buy this option for less than we otherwise would if it were a high implied volatility stock. So that's why when we expect more movement on it, even if we don't know which direction that movement's going to go, because of this disparity between the max gain and the max loss, that's generally more attractive for some option traders there. Okay? Hoping that's making sense. If you have any questions on that, let me know. So let's do this one, but let's say we're going to use stock prices instead of option prices to get in. So let me get out of my drawing tool. And to get in, we said if we break below the 34.10 or $34, we'll say level, we're going to look to get in. So we're only going to get in once we start to make that move down. Okay, that's going to be the first thing. Second thing is, look, I'm going to get out of this trade if this stock breaks above. Well, look, if we're only getting in if the stock goes down, let me zoom in here just a little bit. If we're only getting in if the stock goes down below here, I'm probably going to be able to say this right here is going to be my new kind of resistance point on this. If the stock breaks down, I'm going to call that a resistance. So I'm going to say if the stock goes above, oh, I don't know, we'll say if it hits $35, we're out, okay? We're going to exit at $35. And do we need to put a target? No, we don't need to put it. We could leave the target undefined. I mean, we could say, well, I'm going to get out if the stock goes down here. Well, yeah, we could do that. That about $32.5, I'm going to get out. You don't have to do that, but you can. Let's do this. Let's go to our trade. And here's what I'm going to do. I'm going to redo this. I'm going to right click on the ask price. Okay. And I'm going to buy custom, and I'm just going to say with stop. Now we said we don't want to get in right now. I only want to get in if the stock goes below $34. So I'm going to make this good till canceled market. I'm going to click on that gear, and I'm going to say, we're only going to do this if CMCSA marks less than or equal to $34. That way, if it goes up, we're not getting in. If it goes sideways, we're not going in. Only if it breaks lower are we getting in. Okay? Now, what about the exit? Okay, now let me hit a couple questions up. Okay, but whether to buy this stock to go long depends on this volatility also. It depends on number. Okay, question from John is, what about the implied volatility? Should we consider that? We certainly can, but keep in mind, when we're looking at a stock and we're trying to decide our entry here, we can click on implied volatility here, and you can see this right here. And it's not so much about what implied volatility is, it's more where you think the implied volatility is going to go. This may look like a nice, inexpensive option right now because our implied volatility is basically as low as it's been over the past 6 months. That's great. It means it's cheap. But that doesn't do me any good if the implied volatility does this after we buy it, right? So, but remember, there's kind of 3 main things we're going to look at in terms of defining whether you're going to make money on these options or not. The stock price move, time decay, that's going to work against us on long options, long calls or long puts, and implied volatility. Of these, probably the most important, in fact, probably the most important by a pretty long shot, is what the underlying stock does. Okay, so in this case, we're doing this, but yeah, look, you can look at that implied volatility there. V stands for implied volatility. Time decay, we know is going to work against us. You know, that's a given on these. Now, that's the so why are you doing trade? Well, you know, time decay is working against you. You know that. Short options, time decay doesn't work against you. Well, remember that asymmetry I was talking about just a little bit ago between the difference between potential reward and potential risk? That doesn't benefit you on short options. Time decay benefits you, but the asymmetry doesn't. Long options, the price you pay for that extra potential reward, at least one of the prices, is the time decay working against you. Okay? Good question there. Thank you, John, for that. Sia says, what about doing a, putting your loss at a certain level and gain at a certain level? Here's my answer to that. Always remember your reward to risk ratio, okay? So most long option traders, I can't speak for everyone, but I will say most long options traders will want to maximize the reward and minimize the risk. In other words, have a positive ratio here. Could you flip it around? You could. Now, it can go to extremes. You could say, well, I want a 5-to-1 reward to risk ratio. What's the problem with that? The problem with that is once you start doing that, typically you end up with this kind of scenario that's a pretty low probability scenario of it actually hitting that your target price versus your risk on there. Okay? All right, let's get back to where we were at. Okay, we're putting in this trade. I already marked down what our conditions were for that trade. And I appreciate all your questions, everybody, because you guys are doing great here in terms of questions, bringing up questions that I neglected to mention there. Okay. Here's my entry. We put in the rule on the entry. Just to refresh you on that, we said if Comcast marks less than or equal to $34, we're going to get in. Where are we going to get out? Well, I'm going to do the same thing. This one I'm going to do based on the stock price, not the option price. I'm going to make it a market order, good till canceled. I'm going to click on the gear, okay? And I'm going to say, look, if Comcast marks greater than or equal to This was the bad scenario. We said if it goes above 35, that wouldn't be very good. But get us out, hopefully cut losses. We're also going to click on the line below that. Okay. I'm going to say if it marks less than or equal to 32.50. 32.50. There we go. Okay. So let's save that. Here we go. So there's the trade right here. Let's click on confirm and send and just read this over. Remember to make sure you read the red. Due to potentially wide markets and liquidity risks at the time of activation, the order may be substituted for a limit order. These are actually market orders because we're doing it based on the price of the stock. And this second one, we've chosen a weekly option expiration. Not a big deal. Just be aware of what your expiration date is on those. There we go. That's this. Now, max loss, $96. The max loss on this trade is the amount that I'm spending on that trade. Max gain, don't get too excited that it says $3,400. Realistically, we're probably not going to make $3,400 on this. But, that just kind of goes to the point I was looking at earlier. So let's click on send. And that's a trade we're not going to fill right away. Remember, we're only filling if this breaks down lower. That breaks down lower. Okay. So that's, we did that. Now, can we also do it this way? Okay. Can we also do it this way? Can we also just pull it up right here, add your columns? In fact, I already did it over here. S&P 100. I've got let me make this a little bigger so you can see it. I've got my call sizzle index. I've got my put sizzle index. I can look right up here and I can look for a big disparity between those. The call sizzle index is quite high. Put sizzle index is about average. We can also add in our technical analysis to make sure. I mean, we may on the surface consider that to be a bullish trade, but if the stock looks bearish technically, we may pass that up there in this case. Let's look at AbbVie. Nice call at sizzle index, nice and high, nice and put. Are we bullish on this? Maybe. I already have a trade on it, so I'm not going to do that one right there. Okay. And you can do the same thing on look for higher put sizzle index versus our call it sizzle index for our bearish. So that's a sizzle index, folks. Let me answer questions just to finish up because I'm just about out of time and then summarize. What's the ideal delta? Okay. It depends. And this is something we've covered in past sessions, but let me just give this to you quickly. Very often we'll look somewhere between maybe a 50 delta and a 70 delta. For those of you who are unaware, the delta tells us how much the option is likely to move given a $1 move in the stock price. But it can also kind of locate which strike price you may consider doing. Generally, lower deltas are a little bit more of an aggressive trade, a little bit more leverage with lower deltas. Higher deltas, going to cost you a little bit more, a little bit lower debt leverage, a little less aggressive. So for trend trades, often will go up maybe 60, 70 delta. Swing trades, more in the 50 to 60 range. Can you go out of the money? Can you go to a delta below 40? You can. It's just a more aggressive trade. Okay? On that. So good question. Good question. So let's see. So there we go. So Chris said, well, that'll have a delta. Yeah, remember, we put this order in right here at about probably close to 50 delta. By the time it goes down on a put, the delta will actually be a little bit higher, which is fine. Nothing wrong with higher delta. It's just going to cost us a little bit more on that. All right. Now, there's a survey link in the chat. We do appreciate your feedback. So if you'd fill out that survey, I'd appreciate that on that. So let's go and let me just see we're just out of time. Okay. Yeah, there's a survey link in the chat, and the important part is to reduce the risk. That's why we put in the stop on there. Not technically a stop, it's a conditional order. That's why we put in that conditional order to exit if the stock goes up against us. We did the sizzle index today, folks, because I think it's a valuable way of considering your long options. Put ratio, you can do that put call ratio as well. It's not really the subject of today, but I wanted to mention that. But this can give you maybe a hunting ground, so to speak, for options. You can do them bullish or bearish. They tell you, those sizzle indexes tell you what the volume is. And a lot of traders like to see that increased volume as you trade. Coming up next, we have Getting Started with Technical Analysis. Make sure you check that out. Connie, thank you for helping me on the chat as always. And everybody, have a great rest of the day. We'll see you same time next week. Bye-bye, everybody.